What you are seeing right now on screen is how natural gas prices have evolved over the last few months in Europe. Yes, I know, it will surprise absolutely no one if I say that the cost of gas has skyrocketed to astronomical levels. Another thing that will not surprise you in the least is when I tell you that in both Europe and the United States, we are also experiencing the highest inflation for decades. And let me ask you, does this seem like a coincidence to you? Does it not seem to you that inflation might actually be caused to a large extent by the war? Well, I don't know what you think, but according to many politicians and journalists, it seems clear that it is.
Inflation hits new US record at 8.5%, the highest in 4 decades. Prices soar as the impact of the war in Ukraine is reflected in the sharp rise in energy and food prices.
In theory, blaming inflation on the war seems to make quite a lot of sense. After all, inflation began skyrocketing when Mother Russia started preparing for the Ukrainian invasion. However, let's not go so fast. Let's not jump to such hasty conclusions, because VisualEconomik fans, there is something that we have to show you. Check it out. As you can see, the graph we're showing now is exactly the same as the one we showed before. However, now I want you to pay attention to the additional blue line. This new blue line represents the same cost of gas, but instead of the cost in Europe, it represents the cost in the United States. And have you noticed the huge difference between the two markets? As you can see, the effect of the war for Americans has been much less pronounced than what Europeans have endured. On second thought, this is perhaps direct proof that in reality, the current inflation situation cannot be blamed on the war at all. In other words, if the increase in the cost of energy were the cause of all inflationary ills, since energy prices have risen more in Europe than in the United States, then Europe should also have much higher inflation than the US. So, has there really been higher inflation in Europe than in the US? I'm afraid the opposite is true. Inflation in the United States has been considerably higher than in the Eurozone countries, both before and after the Ukrainian conflict. Without going any further, what this proves is that the theory that war is to blame for inflation is, well, to put it mildly, it simply does not explain what is happening. Which may leave you wondering, well, if not the war, then what on earth explains the massive global inflation that we're experiencing in 2022? Well, at this point comes another rather interesting alternative theory, the money stimulus theory.
Biden's American Rescue Plan worsened inflation. The massive spending law, which included $1,400 checks for each person in a family, generous expansions to unemployment insurance and child tax credit benefits, and hundreds of billions in aid to state and local governments, came at the cost of making inflation worse.
Indeed, many voices point out that the real cause of inflation is not the war in Ukraine, but the fact that after the pandemic, the governments of the world started printing money left and right and spending it like crazy. You know, creating new money usually ends up in high inflation, and if you don't want to take my word for it, then just ask one of our Argentine or Venezuelan friends. But let's take a moment, because with this theory, there is another slight issue. Check it out. While it is true that in the United States there was indeed an enormous increase in money in circulation as a result of the pandemic, in Europe, this supposed large monetary increase did not exist. Despite this, Europe also has record inflation of close to 10%. In other words, post-pandemic printing of new money alone would not be able to explain global inflation. According to conventional theories, that factor alone would be able to explain, at most, the case of the United States. So yes, I know, nothing makes sense right now. There is conflicting information all over the place. So what is really to blame for inflation? What has brought us to the situation that we are in right now? Is it the fault of governments, of companies, of Russia, of the pandemic? What is the ultimate answer? Well, don't worry, this is VisualEconomik, and if we have made this video, it has been precisely to answer all of these questions. And from the outset, we can already tell you that, contrary to what many gurus tend to shout from the rooftops, there is no single great culprit for everything that is happening. Are you ready to learn the answers? Well, let's get started. To summarize, we have so far said that there are two main explanations for the current inflation. One, the printing of new money in the United States, and two, the war in Ukraine. However, we have also said that the war has not affected the United States too much, and that Europe has not produced the massive creation of money that could have caused this inflation, which means that something has to be going on out there in the middle that we are not realizing. It is as if, despite the fact that both regions have very similar inflation situations, the causes of inflation are actually very different. But is this really the case? And do European and US inflations have very different causes? Well, if we want to answer that question, what we have to do is to go back to the beginning of this whole story. We have to go back to the moment when the price increase started to take off for the first time.
Inflation speeds up in April as consumer prices leap 4.2%, fastest since 2008.
As you can see from this last headline, the date when inflation began to set off alarm bells in the West was around the middle of 2021, a time when the worst part of the pandemic was coming to an end, a time when we were able to return to some semblance of normality, a certain normality with some nuances. And the fact is that right around that time, curious news stories also began to emerge, a type of news to which we were not accustomed, and which nevertheless represented a new danger to be taken into account. Take a look.
Microchip shortage plunges vehicle production 25.3% compared to 2019. Since the end of 2020, the manufacturing sector in the Eurozone and other advanced economies is facing increasing disruptions in production processes. Bank of Spain report, March 2021.
Indeed, as many of you will remember, the summer of 2021 was the famous summer of bottlenecks. The summer in which dealerships ran out of cars, and in which buying any product that needed microchips became a complete hell. Well, in a nutshell, bottlenecks were really a technical way of saying that factories around the world couldn't keep up, that they weren't able to produce everything that people wanted to buy. And you may be wondering, but what did all of this have to do with the onset of inflation? Well, since the factories had more orders and customers than they could handle, it was very, very easy for them to raise prices without affecting their profits. So that is exactly what they did. In other words, the first spec of inflation began with the famous bottlenecks. But now, knowing this, another question arises. What caused these bottlenecks in the first place? Did they just magically appear? Well, VisualEconomik friends, this is where the most interesting part starts. Pay very, very close attention. The graph you see on screen represents the consumption of durable goods in the United States up to the start of the pandemic. The orange dotted line symbolizes how this durable goods consumption, taking into account the previous trend, was likely to have increased in the post-pandemic years. In other words, if everything had followed the normal course, the blue line should have followed the orange line over the last 2 years. However, the curious thing is that since the pandemic, this trend has been completely broken. Check it out. Since March 2020, the increase in US durable goods consumption has jumped nearly 30% above its expected trend, which, not to mince words, means that Americans became mega consumers overnight, much more so than we are used to seeing. And take note, because here we are not only talking about shopping at the corner store or at the mall, but also about thousands of imported products that were produced in countries all around the world. Come on, computers, cell phones, televisions, and all kinds of parts for local production among thousands and thousands of examples. To give you an idea, from March 2021 to the time of making this video, the excess of foreign purchases made by the United States exceeded $600 billion compared to its normal trend, a figure that amounts to no more and no less than 4% of the total volume of global trade for a year. And wait, because we're not done. The best part is that while the US was spending money by the bucket load, the Eurozone did the exact opposite. The Eurozone reduced its level of purchases to 10% below trend. So what can we make of all this? Well, it means that by massively increasing their consumption, the North Americans put enormous pressure on production in international factories, thus causing the famous bottlenecks. In other words, the United States massively contributed to the saturation of international trade and the beginning of inflation. Well, once we saw all of this, there were a few questions that came up. What explains why Americans started spending like maniacs after the pandemic? Why did the Europeans, unlike Americans, spend much less? And perhaps more importantly of all, what consequences did this have on other countries? Well, let's take a look.
The price virus.
In the graph that you see on screen, we can see how the disposable income of Americans shot up right after the pandemic compared to what happened in the rest of the OECD countries. You see, when we say that Americans started spending like crazy, don't misunderstand us. We are not saying that they did it because they suddenly got a consumerist fever, but they simply did it because they started earning a lot more money than before, and therefore they were able to spend a lot more than before. To put the data in perspective, wages in the US have risen on average by more than 6% in recent years, which is at least the highest increase in the last 20 years. Such was the rise in salaries that companies began to fight with each other in order to attract workers. That is, they fought to see who paid more, which in turn created what is known as the Great Resignation, of which we have already spoken about on this channel. In any case, what is important in all of this is to answer another question. What is it that made Yankee wages increase so much from one moment to the next? next. The culprit for this abrupt increase in wages was the monetary stimulus in the United States. The new money that was printed, and which, to make matters worse, was largely distributed by the government itself throughout the economy with its famous stimulus checks and plans. It was that money that encouraged consumption, which in turn caused the bottlenecks, and ultimately set in motion the inflation spiral we are now enduring. But wait a minute, does this mean that dollar printing caused inflation in Europe as well? Is that even possible? Well, yes, it is possible. I mean, it is true that it is normally thought that printing money only affects inflation in the country that prints it. What happens is that if that country is the United States, and its currency is one of the most used in the international market, then that inflation can easily end up spreading to other countries. Think about it. For example, Taiwan's microchip factories are inundated. They are inundated both for production going to the United States and for production going to the rest of the world, and therefore prices increase for the rest of the countries as well. This is exactly what explains why the countries of Europe, despite not printing too much money themselves, ended up suffering strong inflationary pressures long before the war in Ukraine. What? Are you surprised? Well, hold on a minute, because the story doesn't end there. You see, blaming the United States for all the bottlenecks and all the inundations of orders in the world's factories would be quite unjust. To be fair, there is another important factor that contributed greatly to the creation of bottlenecks. This graph shows how bottlenecks have affected industrial production in several OECD countries. And it turns out, according to the same study that analysed this data, that more than 40% of the bottlenecks were not caused by the United States, but were caused by the restrictions and quarantines that governments around the world imposed to control the pandemic. Which means that, yes, although the theory of money printing can explain a good deal of the inflation story, it is far from being the sole cause. By itself, it is not capable of explaining the whole process. This time, the pandemic has also played a key role in all of this. Therefore, in summary, we could say that the current inflation was created according to the following chain of events. Firstly, the coronavirus made it difficult for factories and companies to continue with their normal production. Secondly, the United States started printing money in droves and almost doubled the severity of the production difficulties generated by COVID. Then, the stimulus plans and the checks that the federal government handed out to families and businesses accelerated this whole process. And thirdly, Europe and the rest of the world were collaterally affected by the rise in international prices. But of course, to all this had to be added a fourth factor that we have not yet delved into: the war in Ukraine.
Another log on the fire.
We started this video talking about how energy costs had driven up inflation in Europe. So if we want to make an analysis of the causes of the latter, we must not overlook the war. So now the question is, what percentage of the current inflation is due to the war? Well, the truth is that, at least in the United States, everything indicates that the answer is very little. You see, it turns out that if you look at core inflation, that is inflation that measures the increase in price of goods, excluding energy and food, you will see that it has been very, very high since even before the war. In fact, the fact that the price of energy has skyrocketed has to do not only with Russia and Ukraine, but also with the fact that investment in the oil and gas industry has been at an all-time low for the past few years. Be that as it may, if you look at this chart, we can see that even discounting the price of energy from the CPI, inflation is still skyrocketing. To which many of you will surely say, well, actually the price of energy already started to rise months before the invasion of Ukraine. What's more, although core inflation does not include energy prices directly, it is undeniable that expensive energy affects the final price of the vast majority of products. So in reality, the war could explain a good part of the high core inflation. But hold on a minute, because here comes the best part. In 2003, 2004 and 2005, the price of energy skyrocketed in the US in very similar numbers to how it has skyrocketed now. And do you know what the core inflation was back then? It was between 1.3 and 1.6%, which is practically nothing if we take into account that the current core inflation has reached over 6%. In other words, no, the inflationary problem does not lie in energy, or at least not in the United States. Now let's talk about concrete percentages. What percentage of inflation is due to the printing of new money, the pandemic, and the war? Well, to find out the answer to that question, we have to go to a recent article by Adam Shapiro, which outlines that between October 21 and April 22, about 33% of inflation was caused by money printing, while 50% was caused by restrictions and war costs. According to the same author, the remaining 18% was ambiguous and difficult to determine. Alternatively, another study by Oscar Yorda, a Spanish researcher at the San Diego Fed, found that nearly 2/3 of US core inflation could be explained by monetary stimulus alone. In summary, and reviewing all the sources that we'll link for you in the description, we could well conclude with a rough estimate that the blame for global inflation could be distributed as follows. About 40% would be caused by the increase of money in circulation, another 20% due to the war in Ukraine, and finally the remaining 40% due to other supply restrictions, such as those caused by COVID. Again, keep in mind that this simply is a rough estimate that can vary greatly depending on each country. In any case, it certainly helps us have an approximate global vision of the problem in order to be able to deal with it. But at this point, it's your turn. Which argument has convinced you the most to explain inflation? Is there another point of view that we have not explained that you think is important? And how would you solve these problems that are plaguing the West these days? You can leave your answers in the comments. If you liked the video, please like it, activate the little bell so you don't miss any of the upcoming ones, and I'll see you in the next video. All the best, see you soon.